the Financial Survival Network, helping you to survive and thrive in the new economy. Get your free Financial Survival Toolkit and find out where to buy gold and silver safely at great prices. Sign up at financialsurvivalnetwork.com. This is the Financial Survival Network.
1490 WGCH. This is Kerry Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold since 1990, and I'm a customer because when you buy, they ship. To find out more, go to milesfranklin.com or call them at 800-822-8080 and get a free quote. We love to get new guests on the show so that you can hear different ways to plan for the future, and so that you know that even though your retirement might not be the bed of roses that you had originally intended it to be, you still have options. That's why I've got Daniel R. Amerman on the phone. Believe it or not, he was one of the originators of Mortgage Backed Securities when they were a force for good, not a force for evil. And he's thought a lot about the retirement scenario for you. He's got some great ideas, also how you can profit from inflation rather than be crushed by it. Daniel, how are you?
I'm doing really good, Kerry. How about you?
Doing good, and I really appreciate your coming on the financialsurvivalnetwork.com to share your views, because it's something that a lot of people my age, in my mid-50s, a lot of you need to be thinking about is retirement. And we wanted to address a couple of issues first.
If I could just interrupt for a second, though. I wish I had been one of the people who had been involved with the original mortgage-backed securities, but I'm not quite old enough for that. I'm only 52 years old. I was very actively involved in the creation of REMICs and CMOs in the 1980s, back when those were new, and RAID and REMICs and so forth, which is a little bit different, mortgage derivatives and the underlying mortgage-backed securities themselves.
Sorry.
I just wanted to be clear. I wasn't claiming to be part of it.
Thanks for the clarification. So you kind of came along a little bit afterwards and improved on what at the time was a sound concept, wasn't it?
Yes, it very much was so. I mean, the original federal intervention in the mortgage markets goes back to Fannie Mae in the 1930s. So I'm not quite old enough to have been a part of that. During the 1980s is when the revolution really began, when we started taking mortgage cash flows and breaking them up and essentially arbitraging them.
Fast forward to now, all that stuff is owned by the government. The government right now with its deficit, it's really crowding out private capital in the private sector, isn't it?
It is, but I think the issue, I have a little bit different take on the phrase crowding out than the classic economic sense. Classically, when you talk about crowding out, what you're talking about is government borrowing. And because the government is borrowing more and more, and because it has higher credit quality, at least in theory, than any individual corporation, the dollars are supposed to flow to the government, and then private corporations can't get funding. That's kind of the classical definition of crowding out. I look at what I think is a much more important factor on an overall economy sense, and that is essentially what we think of as being long-term investment is based on the assumption of a healthy and growing private economy. That's what stock market valuation is all about. We're saying when the economy is growing, we're going to invest in stocks. We're only going to get, say, a 2 or 3% rate of return on dividends, but they're going to grow so much, corporate profits over time, that it pays us, say, 8% a year or something like that. The problem is that when the government is not just borrowing, but it's taking up an ever larger percentage of the economy, and government spending is growing at a faster rate than overall economic growth, then either we have a drastic slowdown in the private sector, or we even have negative growth in the private sector, and the whole basis for much traditional investing collapses at that point, and I'm afraid we're at that point right now.
The way the government's really financing itself, when you get down to it, is through inflation of the currency. When you see last year, the Federal Reserve purchased 61% of federal debt issued that year. I mean, how can this end well? How can an economy grow when they can just print the stuff up to finance themselves?
They didn't actually do that. They did something that was much worse than that. And a lot of people are failing to understand that. What the Federal Reserve is doing is worse than a blatant monetization. A straightforward, blatant monetization would be where the Federal Reserve is directly purchasing U.S. Treasury bonds, basically effectively creating money out of the nothingness and using that to fund the federal government. They are doing that, but they're doing it in an indirect form where they are purchasing their Treasury securities in the secondary market rather than from the Treasury itself. And in the process of doing so, they are entirely controlling interest rates on both a short-term and long-term basis, which is arguably much worse than a direct monetization. It's a monetization, but the indirect process makes it even worse because we have no free market and interest rates in this country.
And then they're making it appear that the rates are set by the market by the indirect purchase because they're not just out there printing. Either way, the fact is to support the ever-expanding government sector that you described requires the Federal Reserve because there's not enough private capital out there to do it. Eventually, that has to have adverse effects for the value of the currency, the purchasing power of it, right?
Oh, absolutely, absolutely. And I've been calling for this to happen for about 7 years now. Just because I felt this was a very predictable process, that to maintain the status quo, we'd have to reach a point where Treasury borrowing was skyrocket to the point the market could not support it, and then the Fed would, in an unprecedented fashion, turn to creating this money to keep things going.
Yeah,
it's an entirely predictable process.
There's nothing really new about this. If we look through history, been done many times, always with the same result. The difference now, the U.S. dollar at present is the reserve currency of the world, and we're really kind of, I should say the United States government is really exploiting the rest of the world that has been forced to put their trust into the dollar, isn't it?
Who is exploiting who is a very interesting question there. I think there's kind of this basic misunderstanding that says that if you have a strong currency or you have a reserve currency, you're getting a free ride on the rest of the world. And that's true to a limited extent. We're able to buy our energy, our oil, at a much lower price than we should be able to buy it for. We are able to go to a Walmart or a Target and buy consumer goods produced in other nations at a much lower price than we should be able to because we have the reserve currency. But the price for that is the more out of kilter the dollar gets with other currencies around the world, the less competitive American workers become. So when we talk about I did an article recently where I really dug into detail on what the government was doing with unemployment and the different boxes it was basically hiding the unemployed and so forth. I believe that we have a true unemployment rate of about 20% right now instead of 8.2%. And the reason for that 20% unemployment rate is to some extent we're being the sucker for the rest of the world and accepting the status of reserve currency because that makes our workers uncompetitive with everyone else.
I didn't mean to say that it's strictly a one-way street here, but in the final analysis, our workers don't produce and they get to consume as if they were producing. I mean, if you look like the cliche, and I don't buy it totally, is that the U.S. exported inflation over the last decade and a half. That isn't really true because that doesn't really explain what exactly happened. But the fact is, productivity-wise, a lot of jobs got moved out that had the U.S. dollar not been the reserve currency, if there was a classical gold standard, could have never happened, could it?
Well, currencies have always been complicated, whether they're based on gold or not. And, you know, it also wouldn't have happened, let's say, under the Bretton Woods financial system, which was itself based on gold indirectly. You know, everyone else tied their currencies to the dollar, and the dollar was tied to gold. What we're doing right now is kind of unprecedented. And if we did not have the currency rates set the way they are right now, which allows the U.S. to enjoy this higher standard of living in the short term while we steadily destroy our economy in the long term, and then the situation wouldn't exist.
Right. Where do we go forward with this? Because we are in this unprecedented time where there's no backing and basically currency units just get manufactured at will or at need. And where's the world going to head? Are we going to head back to gold or a fixed money supply of some sort? And how much longer can the game go on?
Well, I think our ultimate destination that we'll see sometime in my lifetime is going to be a return to a gold standard. But you got to remember the thing about gold and currency. It comes and it goes. It's happened again and again over time. And the timing of when the government moves to a gold-backed currency is not dependent on when investors want that to happen. It's not dependent on when savers want it to happen. It happens when the government wants it to happen because it serves the interest of the government. So the timing that we look for a return to the gold standard is at a time when the government badly needs credibility, but it no longer needs to inflate away impossible promises. And that's one of the basic themes that I work with from a financial and economic perspective, is that we need to invest for the breaking of impossible promises. And if the government moves to a gold standard at this point, basically they have to explicitly break all those promises.
Sure.
In terms of Social Security, in terms of Medicare, in terms of defaulting upon the national debt. Because if the U.S. government moved to a gold standard next week, let's say there was another banking holiday and the government went to a gold standard when the banks opened up again, then all we've really done is we've made it official the U.S. government is bankrupt.
Yeah, which everybody knows already, but no, it's like a weekend at Bernie's. Nobody wants to admit that Bernie is dead.
But the government's not really bankrupt. And that's where things get a little weird and twisted. Any government that can successfully borrow in its own currency from outside creditors never goes bankrupt. That's the key to the Greeks and the Italians and the Spanish right now. If they were borrowing in drachmas and pesos instead of euros, they would just inflate those debts away in the time-honored fashion, like has happened again and again over the centuries. The rest of the world wises up. No one will lend to them in their domestic currencies, and the situation kind of self-corrects there.
Yeah, well, so how much longer is the rest of the world going to lend to the United States?
Well, that's where things get really complicated from a currency perspective again. The U.S. started moving to currency warfare effectively in 2010. Because the U.S. unemployment situation was so bad. And that was, I think, really a big part of the key to so-called QE2 or quantitative easing 2. It's kind of like Bernanke was publicly standing in front of the rest of the world, central bankers of the world, and holding a dagger to his own throat and said, okay, I'm going to cut it. I'm going to cut it. I'm going to monetize here, and you need to let the value of the dollar drop. And they did temporarily drive the dollar down a good bit in an attempt, I believe, to try to bring some employment back.
So that's the Rickards currency wars meme. So are we still in a currency war? Are they going to do QE3?
Well, the fear, see, what the rest of the world fears is that if they drop the value of the dollar, they've got two major issues that are happening. Number one is they can't import nearly as many goods to the United States as they can right now. So if China and Japan just said, okay, the U.S. dollar is worthless, we're not taking it anymore, what they've just done is they've thrown their own domestic industries into depression right there. So they have a powerful incentive not to do that. And then the flip side of it is if they abandon the dollar and the dollar plunges, then all of a sudden American workers become competitive all around the world. You have a resurgence of employment in the U.S., even as the standard of living drops because it's no longer being subsidized. And all of a sudden, we're effectively competing with the Chinese and Europe and Africa and Asia and so forth. They're not propping us up because they're our friends in any way, shape, or form. It's more like they're supporting a heroin addict.
Yeah.
For their own short-term needs.
So the question is, when are they going to force that addict to go through withdrawal? And for right now, certainly they're not going to do it because they've got enough pressures in China without doubling or tripling their unemployment rate, and their inflation rate is pretty bad as well. So this is going to keep going basically until it stops, right? Until it can't go on.
Yeah, there's a There's different ways the future can go right now. We're kind of at a turning point in the next few years, and there's a reasonably good chance that global depression and effectively currency chaos will be a part of it. And if that happens, all these plans just kind of go out of the window, as they usually do when we have a global crisis. And who knows where we go at that point. But I think as long as the other major economic powers acting together with the U.S. believe they can maintain some sort of facade of control, they're going to continue to do so.
So gold and silver, where are they left in this equation if they can keep faking it, if you will?
I like gold and silver. They are unique assets that do some things really well that basically no other asset will do in a time of currency collapse. And I view them as being powerful insurance policies and really personal security policies. If we hit a period of total collapse in terms of the currency and you can pay in gold or silver and your neighbor can't, you're the one who can get the goods, for instance.
Right.
Where I have an issue with gold and silver is as a chartered financial analyst and former investment banker, longtime MBA, yada, yada. I'm trained to look at the world in after inflation and after tax terms. And assuming that a regime does survive, gold and silver each have acute inflation tax risk.
I'm familiar with the concept.
The basic issue is if a dollar, let's say for round numbers, that gold we're selling at $1,000 an ounce right now. It's not, but for round numbers, let's say it was. And a dollar became worth 10 cents and gold went to $10,000 an ounce. The way the tax code is set up right now, because that would be gold acting as a perfect inflation hedge, meaning it maintains its value exactly in inflation-adjusted terms. The problem that you run into is that the U.S. Treasury, to discourage gold investment and silver investment, taxes them at a punitive collectibles tax rate, which is almost twice the normal long-term capital gain tax rate.
It's like ordinary income, pretty much.
It's getting there.
Yeah.
And it could go higher. That's my fear, is that we're in and we don't have time to go into this today, but we're in a financial repression environment right now.
I agree with you that they will do it, but my feeling is by the time they get to that point, like we're talking about the illusion of control, which is kind of what they're trying to project now, where they've got to go double or quadruple a windfall tax on silver and gold, there will be a huge black market. The validity of the government's taxation is just going to be widely rejected. And that's my feeling on that. I've looked at that because Rickards raised it. Windfall taxes, let's just take all the gold and silver or all the profits, and then nobody will want to own it. But really, you buy gold and silver even to protect against that, don't you?
Well, yes and no. In some ways, just to call it for what it is, where the future is unknown at this point is we kind of have a struggle between, call it upcoming anarchy versus increasing financial fascism. And the problem that we're running into, and when we look at historically things like black markets and so forth, is the world is moving rapidly towards a cashless society. And if you look at various nations like Sweden, and if you look at the financial crises in Italy and Spain, what are they doing? They're putting limits on the amount of cash that can be spent in a transaction. Even as the federal government, as part of the real agenda that was going on with the Health Care Reform Act, is starting to put 1099 MISCs out everywhere, trying to catch all of the economy that they can.
eBay, PayPal, all that good stuff,
Yeah, exactly. And I think the issue is that the government is driving hard towards a point where it's realistic to say cash could be outlawed at some point. And then a black market becomes far more difficult to carry out because you're going to have a means when you want to consume most things that are purchased of somehow getting stuff from a physical, tangible form of, let's say, gold and silver into a electronic economy.
I understand your point there, and I agree with it to some extent, but by the time we get to this point, well, as you said, nobody can predict the future. And you're probably better off having the gold than not having it, even if the scenario that you're describing turns out, because at that point, a lot of people might want to be leaving the country a lot of bad things will be going on. But yeah, financial repression is certainly the rule of the day. And fascism as an economy where the government has merged with the private sector, and they certainly have with the financial sector all over the place. There's not even a dispute to be made. I don't think you can really challenge the concept of fascism as a contemporary economic and political policy of the U.S.
I don't think you can. But the issue is the technology has changed. It's entirely different than when George Orwell wrote 1984. And the government has an unprecedented power to track each one of our spending decisions, even as they track each one of our physical locations to the extent they want to. Increasingly, those are merging with cell phones.
Absolutely. Everybody is voluntarily chipped if you carry a cell phone. They can find you anytime, or you drive your car and it has OnStar, you're tracked. So nothing you could do about that. I don't want to get into those 1984 scenarios. They frighten the heck out of you out there, and they're not pleasant, and there's nothing we can do about them anyway. But something we can do, you've got a seminar coming up on the proper, or I guess the governmentally sanctioned way to profit from inflation, because there are opportunities, right? Every scenario creates winners and losers. How do we become winners from this one?
Well, we got to start studying. And that's what my workshops and DVDs are all about, as well as the free mini course that I offer and so forth, is trying to educate people about how inflation really works, how it doesn't just destroy wealth, but redistributes wealth between people, because I think those are some of the most important financial lessons we have for what's coming up. And I just wanted to say real quickly then, when it comes to the financial fascism, I'm not saying that'll necessarily happen, but I'm saying that the future is unknown at this point. We don't know if there'll be a currency collapse or if there will be financial fascism. And if we invest for currency collapse in the comfort that there won't be a government there to collect taxes from us, and it turns out there's still a government there and it has the most effective means in history of collecting taxes from us, then some classic precious metal strategies can get you in a lot of trouble.
Agreed, but you have to plan for all contingencies, I guess. And there's a limit to what you can really plan for. So in the meantime, it's probably the best thing that's available. But from what you're saying, it might not be in the future. So Daniel, to learn more about you, your investing strategies, where do we go?
Go to my website, danielamerman.com, and I have on my homepage what I think of as a library. I've got an extensive amount of free articles. You don't have to sign up for anything. You just read them on the site, on retirement investing, on how the Federal Reserve creates money, on how the unemployment statistics are manipulated, and so forth. And if people read those and they're interested, then I've got a lot more information beyond that as well.
And Daniel, one final question. What do you believe the true inflation rate is right now?
I think the number that adds up better than anything else is approximately 6%.
6, but we were as high as 10 or 11 last year, fuel prices going up and commodity prices, right?
It's a little hard to say. What you got to remember is the rate of inflation is the heart of everything. Everything from what we believe about economic growth to sales taxes to everything. I think in some key categories, we're obviously seeing far higher rates of inflation when we look at things like food, when we look at education, when we look at healthcare and different categories like that and so forth. But if we had a genuine rate of inflation over, let's say, the last 10 years of, say, 10% or so, then this country would have to be in much worse economic shape than even what we're seeing right now.
So it's a hard number to quantify, but it's certainly substantially higher than the 2% that is claimed by the government at this point.
Oh, absolutely. And, that's one of the things I write about is I call it the second edge of modern financial repression. Is the only way the government can try to keep the lid on when it has these escalating, exploding costs with paying for boomer retirement and so forth, is it has to lie about the rate of inflation. And it's totally doing that.
Yeah. And a lie about the rate of inflation is really a lie about your standard of living staying the same or getting better. It's actually getting worse. So when they lie about inflation, they lie to you about your standard of living.
It is a deliberate systematic theft of standard of living from retirees, public workers, everyone else whose income is based on official cost of living adjustments, even while at the very same time the Federal Reserve manipulation of interest rates to keep them approximately 6% below the rate of inflation is also ongoing theft. You have ongoing theft going on both sides.
Daniel, thanks so much for being on FinancialSurvivalNetwork.com. Link to this interview will be up on the site, as well as many other interviews we've done with noted financial authorities such as yourself. We will definitely have you on again because I want to get more into the strategies of protecting your wealth against inflation and against financial repression, because the two obviously go hand in hand, and you can't plan for one without the other with technology and the ability of the government to steal like never before.
Absolutely. Well, I sure enjoyed the interview. Thank you.
Hey, thank you.